All right, so we have a question here. For company X, we've been given activity for October. They've told us they've produced 1,000 units. They've sold 800 units, and the opening inventory is 300 units. They tell us the selling price per unit is $100. The variable cost per unit with our direct materials, $35, direct labor, $20, sales commission, which is paid per unit sold, $5. The total fixed cost for the month, factory rent, $8,000, salaries, 7,000, marketing campaign, $5,000. They've told us calculate the profit using marginal costing. Okay, so the first step, step one, usually this is the first step most of the time. You want to get your closing inventory. Okay, get the closing inventory. Because in the information, they haven't given us any closing inventory. So to get your closing inventory, it's opening inventory plus units produced minus units sold. Okay, that's how you get your opening inventory. The inventory you start with at the beginning of the month, the units you produced that month, that will give you the total inventory you've had. Then you're going to subtract the units sold so that you see what have we remained with in the factory. So the opening inventory is 300 units, and the units produced 1,000 units, and units sold 800 units. So we're going to say opening inventory 300 units plus 1,000 units which were produced minus 800 units sold. So 300 plus 1,000, you get 1,300 minus 800, you're going to get 500 units. Okay, that is the closing inventory. Any questions on that before we go to step two? Calculate the cost per unit. Okay, the cost per unit. So remember, marginal costing, the variable costs are the ones that are attached to the production costs. Okay, then the fixed costs and the non-manufacturing costs are treated as periodical costs. So here on our variable costs, we've got direct materials, $35, direct labor, $20, and so just those two. Okay. Sales commission, this is not a production cost, but it's also a variable cost, but we're going to include it. But when you're tabulating the cost per unit, focus on the production costs, okay? So we're just getting these two here. So we're going to say direct materials plus direct labor direct materials was $35, direct labor $20. So you're going to say $35 plus $20. That gives you $55. Yes, so this is the cost per unit, $55 per unit. Once you're done with that, then we can now form the profit statement. I usually like using two columns. It makes life easier. Okay. Yes. So the first thing we're going to get is our sales revenue. All right. Sales revenue, it's the selling price multiplied by the number of units sold. So the selling price in this question is $100. The number of units sold, 800 units. Okay, so the sales revenue, $100 multiplied by 800 units. Sales revenue is going to be $80,000. Okay. Okay. Next, we have to now get our variable cost of sales. Okay. So, first things first, we're going to say our opening inventory. So remember, with marginal costing, you're going to value the opening inventory, the units produced, and the closing inventory at the marginal cost per unit. Okay, so opening inventory, it's we're going to say $55. This is the variable cost per unit multiplied by the 300 units. Okay, so these numbers here, I mean this 300, this 1000, and this 500 will be valued at $55. So we're going to say 55 times 300, 16,500. Okay. Then we're going to say production costs. Again, you're going to say $55 multiplied by 1,000 units that were produced. That will give us 55,000. Okay. So 16,500 plus 55,000, 71,500. Okay. 71,500. Okay. You can think of this as the total cost of goods available for sale. Okay. Yes. And then we need to now deduct our closing inventory, okay, to get our variable cost of sales. Okay, so we're going to say less closing inventory. Okay, so we're going to say $55 multiplied by 800 units. Oh, 500 units, sorry. Our closing inventory was 500 units. $55 times 500 units, 27,500. Right. So our variable cost of sales, we're going to say 71,500 minus 27,500. You get 44,000. That is our variable cost of sales. Any questions so far? Okay, then now we're going to add our variable selling expenses. Okay, you say add variable selling expenses. Now remember how here they told us here that this sales commission here paid per unit sold, $5 per unit sold. So we're going to say $5 multiplied by 800 units sold. That is 4,000. Okay, 44,000. So we're going to say 44,000 plus 4,000 to get our total variable costs. 44,000 plus 4,000, we get 48,000. Okay, this is our total variable cost here. Total variable cost. So if we get we can now get our contribution. Remember, contribution is sales revenue minus variable costs. Okay. So we're going to say 80,000 minus 48,000. We get 32,000 as the contribution. $32,000. Okay. Yes. Once we've got our contribution, remember, this is the money that is used to cover the fixed costs. Okay. Now we say less fixed costs. Okay. Less fixed costs. These are the costs that will be treated as the periodical costs. All right. And the fixed costs, they told us rent, $8,000, sales, salaries, $7,000. Let me just bring that near the table here. Factory rent, $8,000. Salaries, $7,000. Marketing campaign, $9,000. So the total fixed costs 8,000 plus 7,000 plus 20,000. 20,000. These are the total fixed costs. Okay. So our profit is going to be the contribution 32,000 minus the fixed cost 20,000. That will give us $12,000. Okay, that is the profit. Yes. So remember, opening inventory, production, closing inventory are the ones that will be valued at the variable cost. These are the production costs. All right. When you're tabulating the marginal cost, the cost per unit under marginal costing, you just focus on the variable production costs. All right. Then the fixed costs are treated as period costs.